Hi there, everyone. Thank you for joining today's call. My name is Erica Hanachek. I'm the Government Affairs Director for the FACT Coalition. FACT stands for Financial Accountability and Corporate Transparency, and we're a coalition of more than 100 state, national, and international organizations committed to combating the harmful impacts of corrupt financial practices and toward establishing a fair tax system. I just want to say thanks again for joining today's call. It's a busy time in the international tax world. We will discuss today the OECD's newly adopted framework on international taxation and reflect on its impacts on U.S. businesses and workers. We'll also discuss how international tax features into the U.S. budget reconciliation process and what necessary steps are up for reform. Well, you may know that corporate tax avoidance costs the world up to $240 billion annually, and the U.S. in particular between $70 and $100 billion annually. The global race to the bottom on taxes denies governments much needed revenues to tackle some of the biggest challenges of our day, including the COVID-19 pandemic, equity issues, and the ongoing climate crisis. Over the weekend, G20 leaders formally adopted a two-pillar OECD framework that will create a global minimum tax on large corporations and reallocate taxing rights on a portion of multinational profits to the world's market jurisdictions. At the same time, the White House and US Congress are continuing to negotiate changes to US international tax law that would overhaul portions of the 2017 Tax Cuts and Jobs Act and bring the US into compliance with at least one pillar of the OECD framework. These changes will prompt enormous strides to improve the competitiveness of US markets and American workers. Now, today's panel will elaborate further on these details, and it's with pleasure that I welcome our speakers, including US Representative Lloyd Doggett, a senior member of the House Ways and Means Committee and representative of Texas's 35th District, Didier Jacobs, Senior Policy Advisor on Inequality and Tax Justice at Oxfam America, Oecd Sarkash, Government Affairs Director of the Small Business Majority, Damon Silvers, Director of Policy and Special Counsel to the AFL-CIO, and Ryan Garul, Policy Director of the FACT Coalition. Now, just a few housekeeping items. We're going to turn it over to Congressman Doggett first to offer some remarks and answer some questions from the attendees, and then be able to move on to the rest of our panel for their remarks in the second set of Q&A. Please submit any questions that you have as you have them through the chat feature in Zoom. After remarks are complete, we will turn it over for a formal Q&A where you can unmute yourself. So please feel free to use the raise your hand feature as part of that as well. And then when panelists speak, we just want to make sure that your mic is muted. So without further ado, let me turn it over to the Congressman for his remarks. Thank you.
Well, thanks so much, Erica. Thanks for today and for the leadership of the FACT Coalition and the role that each of the panelists here and their organizations have played in helping us achieve success. What happened in Rome, what was finalized in Rome this past weekend is truly historic. It really reflects decades of work and is culminated with the very determined work of Secretary Janet Yellen with the supportive leadership of President Biden. Working together, they have led 136 nations from around the globe to put the brakes on the global race of taxation at the very bottom by instituting this 15% minimum tax. So today we are celebrating the success as well as the progress that has been made in the tax portion of the Build Back Better legislation that I hope will be approved this week, and renewing our commitment to continue this long struggle for a more equitable tax code with fewer injustices and fewer incentives for mega corporations to ship our jobs and their profits overseas. The FACT Coalition has championed this cause for many, many years. We are on the verge, I think, of achieving meaningful reforms to our tax code that will make our American workers more competitive and will assure a more level playing field for the many small businesses or larger ones that are principally focused on the domestic market, but must compete for capital and employees and everything else with some multinationals whose principal focus may be overseas. We're reducing the tax breaks and eliminating some of the loopholes that allow them to book profits overseas and ship jobs elsewhere. The OECD Agreement and Build Back Better, I think, mean that American workers will have an advantage and American-based businesses will have an advantage. There will no longer be a giant tax break for sending a factory overseas. This is real progress, and it puts an end to a lot of the abuse of offshore tax havens. It means we will have the resources to fully pay for many of the critical investments in childcare, in education, in healthcare, that will allow us to advance our economy, to green our economy, and benefit families across this nation. Certainly, I and the other groups that are here would have preferred to have accomplished much more, to have adopted all of the international tax reforms that were requested by President Biden. His bolder, his more comprehensive policies, that the sixth system that really we have on tax needed healing. My own No Tax Breaks for Outsourcing Act that was co-sponsored by a majority of House Democrats was designed to equalize the domestic corporate tax rate and the rate on foreign profits. Build Back Better narrows the gap, but it leaves some corporate taxes too low, in my opinion. We know from the Joint Tax Committee that American multinationals have been paying a rate of less than 8%, while their operations abroad were at 18%. So the argument that we needed to be restrained because this would adversely affect the competitiveness of American multinationals was phony from the start. Build Back Better does represent a significant amount of revenue from profitable multinationals. It's time they pay their fair share, and they will pay a fairer share under this law than before. And I'm hopeful that we will build on it in the future and continue to plug the loopholes. We know that some of the smartest and most creative people in the world are working with these multinationals to find ways, even as this law has yet to be adopted, to get around it. And so it will be our job to assure effective implementation of the 15% global minimum tax, both here and abroad. And I know our coalition will remain actively involved to seek the tax fairness that Americans deserve. And with that, I'd welcome any questions or comments that may be there. And I know that our panelists, while they haven't fully made their presentation, they'll be available for any of the hard questions. Got any for me, Erica?
Thank you so much, Congressman, and thanks so much for your leadership on this issue. It's amazing to see your career through Congress, being able to be a champion for raising the rate on multinational corporations and establishing some fairness. And I do want to inquire, as we move forward through the Build Back Better Act, what are the opportunities that you might see for ways that we can continue to build on that progress and meet the standards that you've outlined as part of the No Tax Breaks for Outsourcing Act, which is a piece of legislation all the groups on this call have supported. So I'm curious about what you see as the next step forward.
Well, I think it's a matter of working carefully with the Treasury Department on implementation here, accountability. As you know, while I would have much preferred, and I know the groups on our call would have, to have this in place immediately, it is delayed a year. We will begin to see what other countries around the world are doing. There's still some other provisions concerning international tax that could constitute continuing loopholes to see what's done there, whether Treasury needs to adopt any further rules and regulations necessary to accomplish this. I guess in short, it's first being sure we get Build Back Better actually signed into law so that these reforms are adopted. But secondly, it's a matter of continued accountability and engagement to watch how this is being implemented. I think that it's unlikely that to actually implement the global minimum tax, that there's further legislative action necessary in terms of passing new laws, but there may well be, at least as to the first pillar of what was agreed to, the need for some revisions of tax treaties over in the Senate. And so we'll be following that as well.
Great. And I know we'll all be watching with bated breath as the Senate identifies its next steps. And really, we're very grateful to you for everything that you've been doing. In terms of the impact that this agreement will have on the average working American, I wonder if you could elaborate a little bit further about impacts that you might see in the district or for average constituents, and how this might interact with their every day-to-day life.
Well, we know that despite claims to the contrary about how the Trump tax law was going to stop offshoring, that it has continued. That you can look at one place after another and see good paying jobs being shipped to Mexico, being shipped to some other country with a direct tax incentive that your taxes would be lower if you built your plant in Santiago rather than in San Antonio or in Shanghai. So I think that so often the benefits are not as immediately felt when they are preventive in nature, but that's what we're concerned about is how do we prevent more of these jobs from being sent offshore and keep them as good American jobs. That's been the focus in a broader sense of the Biden administration of building back better for more good paying jobs in America. This bill will help remove the incentives, not remove all of them, but remove most of the incentives for constructing plant and equipment abroad. And then secondly, as we move forward, there is, as you said in your opening remarks, a tremendous amount of revenue that is lost. It's lost to the world. It's stateless income. And we will begin to recapture some of that as there are fewer places to hide it and there are penalties under Build Back Better for those who decide to continue hiding their revenue in offshore tax havens that are not participating among the 136 countries. So I think those are the main areas. It is a matter of reminding our neighbors of how much has been lost in the past, how much is shipped away overseas, and how little these multinationals are contributing to the cost of our national security and other vital public services. And that would also be one of the accountability measures to take a look back as we move forward to see if this low level of taxation at less than 8% remains or whether we begin to see some real change there.
Wonderful. Thank you, Congressman.
Thank
Now,
you.
I don't want to hog all of your time, so I want to make sure that our colleagues on the
Absolutely.
call are.
And I'm sorry not to stay and join all of them, but welcome further follow-up questions to our office. And again, I want to say my heartfelt thanks to each of these participants in your panel for the role that they played in keeping up the engagement with members of the Ways and Means Committee, the Senate Finance Committee, and colleagues generally. That's what it will take to get this bill signed into law, and that's what it will take to assure that it is meaningfully implemented. Thank you all very, very much.
Congressman, if you still have a minute or two, I just want to make sure our colleagues that are from the press have a chance to answer ask you a question. So
Sure.
Our press colleagues, if you want to unmute yourself, feel free to introduce yourself, name your affiliation, and ask the Congressman a question. You can also submit any questions you might have by chat.
Anything else there, Erica?
That's all, Congressman. Thank you so much for your time. And we'll make sure to have folks follow up with your office.
Great. All the best.
Take care. Bye. Well, thank you, everyone. And thanks to the Congressman and his team for being here today. Let me turn it over now to the rest of our esteemed panel to offer their perspectives on the recently adopted agreement and its impact on the U.S. So without further ado, let me turn it over to Didier Jacobs.
Yes, hi everyone. I'm from Oxfam, which is a global campaigning organization dedicated to fighting poverty and social injustice. And we work on tax issues in about 20 countries as a means to fund economic and social development. So we are very glad that the world has reached this agreement. And I'm going to briefly explain what the agreement is, the global agreement, and then talk about its impact internationally. So what is this? With this agreement, it's an agreement between 136 nations, so it's not all the countries on Earth. It is an optional agreement, but we nevertheless expect that nearly all large multinationals will pay at least 15% tax on their profits in almost all the countries where they operate. So when we talk about large multinationals, we're talking about multinationals that make over $800 billion in revenue a year. And the only industry that is excluded is shipping. And the only profits that would fall through the cracks of this global agreement are profits generated by companies whose home country opt out of the agreement, and profits made by these companies in countries that also opt out of this agreement. So if, say, Switzerland opts out, then the profits of Swiss multinational companies made in, let's say, Bermuda, if Bermuda opts out also, those might fall through the crack. But we expect actually very few countries to opt out, and this is the key of the agreement, because there is a built-in incentive to opt in, and that is that the countries that opt in have the right to tax the profits generated in the countries that opt out if these countries don't tax it themselves. So for instance, if a US multinational companies make some profits in Canada, and Canada itself does not levy at least 15% tax on the profits, then the United States can raise the tax on those profits raised in Canada. And that is a strong incentive for Canada to raise the taxes itself, because otherwise all the money will go to the US, and there will be no point having a low tax rates because the multinationals will be taxed anyway, so that there is no tax advantage of investing in Canada. I should note that there is a carve-out for the first 5% return on the physical investment, so the true minimum tax will actually be a little bit below 15% depending on the type of investment. And this agreement does not require any treaties, international treaties, so each government can henceforth implement them, the agreement in their own tax laws. The OECD is going to issue guidelines in the next few months about it, and we expect this global minimum tax to take effect in most countries from the start of 2023. So what is the impact for the United States? It's estimated around $350 billion over a 10-year period in the reconciliation bill that we are going to talk about in a bit. So that is a tax increase for US multinational corporations. Nevertheless, it does not harm their competitiveness at all. On the contrary, I would say that it improves the competitiveness of US companies, because the foreign companies will see their taxes increase even more. And that is because the US starts from a situation where US multinationals already pay 10.5% tax, minimum tax on their overseas profits, while foreign multinationals typically don't pay any taxes on their foreign profits. So the US multinational companies will see their tax rates on foreign profits move from 10.5 to 15. That's an increase, but it's much lower than the increase of foreign multinational companies that will see their tax on foreign profits increase from 0% to 15%. So relatively speaking, the competitive position of US multinational companies should improve. Now, as you've heard, Congressman Doggett, this coalition is of the view that it was not really necessary to improve the competitiveness of US multinational corporation. Indeed, we believe that there is room to increase the tax rate of US multinational companies on foreign profits beyond, above the 15%, and still leave US multinationals in a similar situation as compared to the status quo. And finally, another international impact, of course, we are talking about ending this race to the bottom. That means that all foreign countries that, as I say, currently don't raise taxes on the foreign profits of their multinationals will henceforth do so. And so that will increase tax revenues abroad as well. And also in developing countries, which Oxfam cares about, it will allow governments to reduce tax incentives that they typically offer to attract investments. And so they, even though they will not benefit directly from the minimum tax, they will be allowed to increase their regular income tax without fear to scare away foreign investments. So with that, I'll pass it back to you, Erica.
Great, thank you, Didier. I'd next like to invite Oecd Sarkash from Small Business Majority to offer her perspective.
Thanks, Erica. Hi, and good afternoon, everyone. My name's Oecd Agreement. I'm the Government Affairs Director at Small Business Majority. We're a national small business organization that empowers America's diverse entrepreneurs to build a thriving and equitable economy. Our network represents over 85,000 small businesses and 1,500 business and community organizations that advocate for public policy solutions and deliver resources to entrepreneurs to promote equitable small business growth. I want to start out by saying that the fact is the tax system is skewed toward the wealthiest corporations and Americans at the expense of small business owners, their employees, and independent entrepreneurs. As most small businesses agree, 85% of small businesses feel that the tax code unfairly benefits large corporations over small businesses. And 7 in 10 small business owners feel that they are somewhat or greatly harmed when big corporations use loopholes to avoid taxes. 69% of small businesses support the idea of implementing provisions that would help ensure wealthy corporations and individuals pay their fair share. Very few small businesses have the scale or resources to take advantage of tax loopholes available to large corporations. And yet many continue to propose tax policies that are cumbersome and only benefit the wealthiest corporations. So really the bottom line, the interests of the smallest of businesses and those of large corporations and the wealthy are not really aligned. Small businesses want a level playing field. They felt this way before the pandemic. They have felt it during the pandemic as well. That's why we're heartened to see that the Build Back Better framework will impose a 15% global minimum tax. And in fact, when we polled on this, 2/3, over 60% of small businesses supported setting a minimum tax of 21% on corporate offshore profits. And so to Didier's point, there is support, especially among small business owners, for increasing that amount. So it's critical that we continue to do more to level the playing field by passing this provision and others for small businesses, especially the investments, especially because these pay for the critical investments in the Build Back Better framework. And Erica, back to you.
Thanks so much, Oecd. Next, I'd like to invite Damon Silvers from the AFL-CIO to address his concerns. Thanks.
All right. Thank you. First, I want to just say on behalf of the AFL-CIO and our 12 million working families, what a pleasure and honor it was to be with Congressman Doggett. He has fought and fought and fought on this issue, and the working people of the United States are grateful. Also, what a pleasure to be with all my fellow panelists here that really reflect the full range of public interests involved in this issue. Now, let me just say a word about what this addresses, and then about what it means to working people. So this is about a successful effort by the Biden administration, spearheaded by Treasury Secretary Janet Yellen, to address one of the single most outrageous aspects of the way that our tax system and our government have worked in recent years to worsen inequality and to try to essentially make it easy to move good jobs offshore. Right? What our international corporate tax system has worked in two ways: before Trump and after Trump. Before Trump, it was bad, and after Trump, it was worse, in the sense of more and more subsidies directed toward companies that offshored jobs. Now, what that meant was that before Trump, a company that was in name based in the United States could move all of its actual operations, all of its actual jobs offshore. And if they were offshore, then as long as the money that they earned stayed offshore, they didn't have to pay any taxes. If they kept their jobs in the United States, then they'd have to pay the full corporate tax rate. It doesn't take a big genius to figure out that if you're trying to make money, it is advantageous to be in a position offshore where you don't pay any taxes. Now, the key to that system was that you needed to be in countries that themselves had low corporate taxes. It was a kind of conspiracy between global corporations based in the United States and low tax countries around the world. Trump came along, promised to fix it, but instead changed the rules so that you could bring the profits back from offshore and pay no more than 10% taxes on them. Whereas businesses based in the United States, employing people in the United States, small and medium-sized businesses with no capacity to go offshore, they were paying 28%. So the system as President Biden found it was one where where businesses that created good jobs in the United States paid well, Trump cut the overall rate. So countries creating good jobs in the United States paid 21%. Companies moving jobs offshore paid 10%. The Biden and Yellen initiative went at the heart of the problem, but by going to the countries that were running the low tax rates and essentially leading a global effort to put a floor on the race to the bottom. And that floor is 15%. Doing that essentially takes what was a 10% minimum rate and increases it from 10 to 15%, almost by 50%. It's a huge achievement. Now, as all the other speakers have said, the international labor movement in the United States, the labor movement around the world, wanted that rate to be 25%. We worked with the Biden administration and with Secretary Yellen, who fought for 21%. In the end, the pressures in the global economy pushed it down to 15, but 15 is still a gigantic victory, both in terms of the number and in terms of the principle of there being a global minimum tax. And what does that mean for working people? It means three things. It means first, we're pushing back on a 50-year trend of taxes being paid more and more by ordinary people and less by giant corporations and billionaires. So first, it's a matter of simple fairness. Who pays the taxes? Working people have been on the losing end for decades. President Biden and Secretary Yellen struck a powerful blow for the basic notion of fairness in the global tax system for working people. Secondly, it's a question of whether or not we are actually incentivizing through our tax system the loss of good jobs. The global minimum tax pushes back against those incentives in a very significant way. There's more to be done, but it establishes the principle that the United States government should not be actively aiding people moving jobs offshore. That's what Donald Trump did, actively aid people moving jobs offshore. Joe Biden and Janet Yellen have pushed back in the direction of ending the subsidies for taking good jobs away from Americans. And then thirdly, it raises revenue. It raises desperately needed revenue, not just in the United States, but all over the world. The revenue we need to really contain COVID, the revenue we need to fight climate change, the revenue we need to build a fair and inclusive global society. And so those three things are enormous, enormous achievements. And the labor movement in the United States and around the world is grateful to the Biden administration, and particularly to Secretary Yellen, for fighting for and winning, for the first time, a meaningful global minimum corporate tax. Thank you.
Thanks so much, Damon. Thank you so much for that really helpful overview. I'm going to turn it then to Ryan Garul from the FACT Coalition as our last and final speaker. And I know we want to make time for questions, so we'll make sure to hit that as soon as we're finished with Ryan's remarks. So Ryan, turning it over to you.
Yeah, thanks, Erica. I'll be brief. The OECD agreement is historic, and it's a call to action for Congress. Under the agreement, the US has every incentive to amend its current tax treatment of multinational corporations. As others have mentioned, this includes increasing the US GILTI rate, or Global Intangible Low Tax Income rate, to at least 15%. As Damon mentioned, it's closer to 10.5% today. It also would require the US to change its GILTI regime to apply on a country-by-country basis. This is important as it addresses significant planning opportunities presented by the current ability to blend foreign tax credits and other attributes today, which encourages pay-for-profit shifting. Additionally, the US should eliminate the exemption for foreign oil and gas income that is currently included in the GILTI. The framework also encourages us to strengthen measures within the code to protect against base eroding payments. For example, the OECD agreement encourages the US to reform its base erosion and anti-abuse, or BEAT tax, to employ a higher rate to deemed base eroding payments or deductions, and to increase the base of payments to which the regime applies. There are some open questions around it, of course, including with respect to timing. As Representative Doggett indicated, these changes are to be implemented by source countries or jurisdictions in the case of Pillar 2 and Pillar 1 by 2023 for most changes, with the appropriate legal action occurring in 2022. One portion of the Pillar 2 tax, the undertax payment rule, which is closer to our beat, is to be implemented by 2024. However, there's no requirement that these rules cannot be implemented until 2023 or 2024, respectively. And when profit shifting or base erosion is occurring today, we might ask why the US would delay these reforms at all. While implementing these reforms sooner in the US will be almost assuredly not impact competitiveness, it will cost tax dollars that can make Build Back Better investments stronger today. There's also potentially a significant political risk in delaying any of these changes, which is why it's so important to see Congress act on these as part of the Build Back Better agenda and to move that forward. Additionally, there might be issues with respect to precisely pinning down the appropriate tax base, definitions, or political action questions around implementing multilateral, bilateral arrangements by participating jurisdictions. But as Didier mentioned, the deal will encourage participation by many jurisdictions. And we should also note as an open item, the rate itself, while it has been set at 15%, that itself is also not a hard ceiling. And the US should and could consider increasing, for example, the GILTI rate above 15%, as there's no reason why it can't under the deal, if doing so continues to leave US multinationals as competitive and helps to fund investments like those considered under the Build Back Better investment plan. Finally, there are some broader implications that we might consider as part of this deal. World leaders are moving from this weekend's OECD conversations right into the 26th UN Climate Change Conference of the parties. And a singular open question is whether collective efforts like the OECD actions over the weekend can work to be a model for collective action with respect to climate change and other critical global challenges. And I'll pause there.
Great, thank you, Ryan. Again, we're going to turn it over now to questions and answers. So for folks that want to submit questions by chat, feel free to do so. Otherwise, you can use the raise your hand feature to notify yourself that you want to be called on, and then we can have you unmute and ask the panelists directly. While we wait for folks to get their questions in order, let me go ahead and pitch the first question and ask you a little bit, this is probably to the panel, about the interaction between the reforms that we see under consideration in US Congress, and then also that's been agreed to at the OECD with another story from the past month, the Pandora Papers. I'm curious if you can speak a little bit to that and the interplay of tax avoidance and some of these broader questions that we see about secrecy jurisdictions and tax haven abuse. Perhaps Ryan, you could take the question first.
Yeah, absolutely. I think the Pandora Papers revealed once again how there are potentially two different financial systems in the world that allow different players to play with different sets of rules. You have a set of rules that America's working families and good tax-paying citizens are abiding by, and then you have a different set of rules that apply to the global elite. And while the Pandora Papers themselves were not as implicating with respect to multinational enterprises as, for example, previous releases such as the Paradise Papers might have been, they still exemplify the fact that creating tax systems like those that are currently in place, which incentivize multinational entities to shift profits offshore, to engage in illicit financial flows, and to take advantage of secrecy jurisdictions, helps to legitimize those very actions and helps to create as politically powerful the entire movement to create offshore tax systems or offshore financial systems, which, as it turns out, aren't so offshore after all, when you look at things like the US tax system and the way it encourages and also politically legitimizes these separate financial systems.
Great, thanks. Do any of our press colleagues have any questions to answer? I have plenty I can ask myself, but I want to give folks the opportunity. All right, well, I have plenty of questions. I wanted to turn it over to Oecd. We've been talking a lot about the support behind some of these reforms and looking at the US context. I'm curious, Oecd, if you can help shed a little bit more light about some of the public support from amongst your members and small business owners for Build Back Better and other initiatives.
Yeah, thanks, Erica. I alluded to this in my remarks, but we see strong support for these revenue raisers across the board with small businesses, largely because over 73% of them feel that the tax system favors big businesses, which is exactly why we saw really strong support for the minimum global rate. When it comes to the investments and why we need these provisions in the first place to level the playing field for small businesses, that sort of coupled with the other investments that we hope to see, like paid family leave, childcare, providing medical leave, parental leave, and other types of investments. These are really critical resources for small businesses. They want to be able to provide them to their employees. They're often sort of already competing at an unfair disadvantage with a lot of these larger corporations, which is exactly why they find these investments to be so critical. And that, again, sort of coupled with leveling the playing field with the tax code is really imperative to them. We saw over 63% of small businesses feel that families shouldn't have to pay than 1.5 times or 7% of their income on childcare. We also see really strong support for providing access to medical leave, 73% support, and almost 70% for parental leave. And so this is something that small businesses support, and they also support how to pay for them.
Great. Thanks so much, Westa. Well, maybe Damon, I could ask you a question then also. I mean, there's an argument right now that's being made by some multinational corporations that now isn't the right time to be advancing some of these reforms. We're in the middle of the pandemic. What do you make of some of the arguments that advancing international tax reforms at this point in time would be damaging to American workers? Does that hold water, or what's the view from the AFL?
Well, I think we think that sort of thing is silly and self-serving. I give you an example of the kind of thing that goes on in this argument. If you Google the sort of labor share and corporate tax, you will get a long list of articles arguing that it's workers that actually bear the burden of corporate taxation. The studies that argue that are not very well respected in academia, but the hilarious thing about them is that they argue that we should not tax corporations because somewhere between, according to the corporation's own paid academics, somewhere between maybe 10 or 15% of the total amount of money that's going into corporate taxes might come out of workers' pockets. 85% comes out of corporations' pockets. That's the corporation story. What we know, all right, the truth about this is that since 1950, for 70 years, the share of the tax base of the United States paid by large corporations has fallen, and the share paid by working people has risen. Right? I suppose if you argue that now is not the time you think is ripe for this kind of reform is when workers pay all the taxes and corporations pay none. We would prefer to do it now.
Excellent. Thank you. Thank you for your response. Perhaps, again, borrowing questions from some of our colleagues on the call, alternative.
Erica,
yes.
Do you mind if I just follow up on Damon's point just a bit there as well?
By all means.
Damon makes excellent points. We would just add to that just recently, recently as last week, it was confirmed that the wealthiest 10% of Americans own a record 89% of all U.S. stocks. I'm sorry, the wealthiest 10% worldwide own a record 89% of all U.S. stocks. And of that portion, it's also important to note that U.S. stocks are held now in record amounts by foreign stockholders. And as other means of funding the Build Back Better investments have not materialized, the ability to tax multinational corporations appropriately is one of the few ways that we are actually going to be able to tax billionaires or foreign taxpayers who invest in U.S. markets as a result of these different plans in order to more fairly and equitably raise revenues for the Build Back Better investments. So that's one of the reasons why it's also a critical way to raise money as part of these processes as well.
Great, thanks, Ryan. Didier, maybe I'll pitch the next question to you. I know in terms of some of the perspective of members of Congress, there have been a couple of letters that have been circulated demonstrating concern about some of the timing around ways to advance U.S. International tax reforms in relation to the OECD. It's a matter of timing. How do we sequence this appropriately? And especially as we talk about some of the bigger reforms that the groups on this call have advocated for, that Representative Doggett alluded to, and better equalizing the differential between the U.S. and foreign foreign rate for corporate taxes. I am curious about what you view in terms of that sequencing and in terms of those next steps, whether there's any water to be held about us getting ahead of the OECD. Can you address a little bit more about what this means in terms of now that the OECD has formally adopted this agreement over the weekend, if the US moves forward with reforms, what can we expect next? And, just address some of those concerns around that.
Yes, so the OECD agreement has been under negotiation for over 2 years now. And of course, the Biden administration started working on that earlier this year. In the first few months, there was a question mark about the relative timing of each. And it turns out that there has been a almost complete convergence, with the G20 making this agreement a couple of days ago. And we expect hopefully a vote on the US part of this perhaps this week. So in terms of decision making, there is a complete convergence. In terms of implementation, we would like the US part of it to be enacted starting from the beginning of 2022. The agreement that was published last, or the tentative plan that was published last week for the US proposes to delay that by a year, so that it will be at the same time as the OECD or the rest of the world would basically move for implementation starting at the beginning of 2023. There is really only 1 year gap, which in the grand scheme of things does not matter at all for investment decisions. If a company, a multinational company is considering investing abroad, selecting a country, etc., it's not 1 year of tax that's going to influence their decision. But it is 1 year of revenue that makes a difference to fund some of the initiatives here in the US. So we believe that it should really be brought forward and for implementation from 2022, not 2023. And as several of us have said, there is plenty of room to increase the rate beyond 15%, because companies now, as I've said, they already pay more than their foreign counterparts, and there is no strong evidence that US multinationals are harmed by a lack of competitiveness. So if you just look at how the US stock market is doing, it's pretty clear that US companies have a very easy access to global financial markets. And if you look at the rate, so we are talking 15% is really the minimum rate. And it's a rate that will really apply mainly to small countries that now have lower rates, and they use that as a means to attract investment. We're talking countries like Ireland, Switzerland, Hong Kong, Singapore. Those countries tend to have low rates, and it helps them a little bit to attract investment. But they are small countries. There's only so many workers there. The truth is that most US multinationals invest in large countries like India and Germany and Canada and Mexico. And all these countries already have rates well above 15%. And so investments in those countries will not be affected by this global minimum tax. And even at a rate of 21%, as the president would like, again, it wouldn't have an impact on investment in those countries, which are really the main destination of US foreign investment. So this whole argument of competitiveness that has a few congressmen worried is really hyped by the multinational corporations themselves, which of course want to pay as little tax as possible, like anybody. But in truth, there is very little truth in their argument that a higher guilty rate would harm their competitiveness on global markets. And the price that is paid by having a low rate, like 15%, is that then it's the workers and the small businesses that will basically pay for the bulk of this investment plan. So yeah, that's basically the answer. I think it's a hyped up argument that, and we could move sooner and go further than Congress is contemplating.
Great. Does anyone else on the panel have anything to add? Great. Thank you. Thank you, Didier. Well, I'll ask one last question, then we can close out the conversation. But it strikes me that knowing the importance of the OECD reforms, but also, of course, the reforms that are in front of the US Congress in order to raise revenues, to pay for social goods, there's obviously a public stake in making sure that these reforms are properly implemented. So I'm curious, just to ask the broad question of the panel, how will we know if these reforms are successful? Are there other reforms that we might consider making that would give some public accountability to making sure that we can actually hold these corporations to account for paying the taxes that they would otherwise owe?
Erica, can I just speak to that briefly? The obvious thing is country by country disclosure of tax payments by public corporations. This is something that is within the power of the Securities and Exchange Commission and of the Financial Accounting Standards Board. And there are a number of investors who are suspicious that the companies they're investing in have unsustainable tax profiles that have been asking for these reforms for years. And they are an essential component of ensuring compliance. But I also think that one of the virtues of this reform, I would say there were two things that maybe we haven't really touched on quite enough. And one of them is that the really revolutionary thing about what the Biden administration has achieved here is its directionality. That the direction of tax policy globally has been increasingly, has been for decades in an accelerating direction toward essentially rendering large corporations and the very rich immune from paying taxes. This is a serious reversal of that trend and a movement in the direction that the American people would actually support. The other, and so understanding that reversal is really what is dramatic and remarkable here, and that it needs to be built upon. That's point one. And point two is that because of the mechanism that was been used to enforce this, the truly global nature of the mechanism and the way in which it attaches both to where the companies are domiciled and where they do business, it's actually relatively easy to monitor whether or not it's actually working. It will be relatively easy to look at the taxes paid line in any financial statement of any public corporation located anywhere in the world and ask yourself, is that 15% of profits? Right? That's going to be that's something that pretty much any kind of minimally financially sophisticated person can do. And I think that it will be very interesting to see whether or not this mechanism actually succeeds, or whether or not we'll have to get tougher. But the principle has been established, right? That basically all of the major economies of the world subscribe to the notion that no corporation should be getting away with paying less than 15% in taxes. And today, as we sit here, most of the famous brand names that we know of are in fact getting away with that. So now we have both the rules and the tools to change that.
Great, thank you so much, Damon. Any other final remarks from our panelists today?
Erica, I guess I'll add to what Damon said and echo many of his sentiments. I think he was right on in most of his responses. To give a little bit of color to the public country by country reporting mechanisms that Damon's talking about, currently public companies report their taxes based on an aggregate basis for international versus domestic taxes paid on their SEC filing reports or other public filing reports. And so there's really no insight for investors, public officials, or civil society or academics as to how multinationals are actually paying their taxes on a country-by-country basis. With these proposals, for example, switching the GILTI regime to be on a country-by-country basis, it becomes more important than ever to understand how multinationals are actually engaged with these laws and to make sure they're being implemented as intended by Congress. And for example, the IRS might already have access to a lot of this information under an OECD information sharing agreement. However, the IRS's audit function doesn't really measure whether or not the laws are being performing as intended. They're really just making sure taxpayers are complying with what could be broken laws. So it's really important for this reform to go through the public country-by-country reporting that Damon's mentioning. The other thing that I think we might look for, to echo what Damon said, building off the reversal of the ratchet effect, as it's sometimes called, is to just make sure that, and to see how these processes themselves might improve as a result of being successful. In other words, I think that the OECD process could result in a tremendous achievement for collective action to what is a collective problem, that is corrupt or financial illicit flows that stem from things like secrecy jurisdictions or tax havens and those markets. However, simply by being successful, that might instill more success within the processes themselves. That is, the OECD process itself might become more transparent and more inclusive of not just US concerns going forward, but also developing nations, to help create even more successful arrangements going forward that can help to address challenges like the global corporate race to the bottom, or hopefully things like climate change and persistent inequities that we see both at home and abroad.
Great, thank you, Ryan. And thank you so much to our panelists for being here, and for the members of the press and others that have attended today's call. We'll be sending a follow-up email immediately after this session with statements from the members of the panel, and we are available as a resource for whatever questions you might have that might be forthcoming. But thank you for your time, and looking forward to continuing to cover these challenges ahead together. Thank you. Enjoy the rest of your afternoon.
Bye.
Bye.
Thank you so much. Thanks all.